Introduction to Nixon Shock. Imagine sitting in your living room on a quiet Sunday evening in 1971. The television is on, and suddenly the President of the United States, Richard Nixon, appears. His tone is serious, almost tense. He announces something that sounds temporary, almost harmless at first. The United States is closing the gold window. But what does that actually mean? It means that the US dollar, which had been tied to gold for decades, will no longer be exchangeable for it. Not even central banks can convert dollars into gold anymore. At that moment, most people did not fully understand the magnitude of this decision, but in reality, this was the beginning of a completely new financial era. System changes. Along with closing the gold window, Nixon introduced several additional measures. He imposed a 10% import surcharge to protect American industries from foreign competition. At the same time, he froze wages and prices for 90 days in an attempt to control inflation. These actions were presented as temporary solutions to stabilize the economy. However, what is important to understand is that this moment marked the end of the gold-backed monetary system. The dollar was no longer anchored to a physical asset. Instead, it became a fiat currency, based purely on trust and government policy. Lasting impact. What makes this moment so important is that these so-called temporary measures became permanent. The global financial system shifted from a gold-based system to one based on floating currencies and trust. This decision changed how money works forever. It allowed governments more flexibility, but also introduced new risks, especially inflation. The Nixon shock is not just a historical event, it is the foundation of the modern financial world we live in today. Bretton Woods crisis. To understand why Nixon made this decision, we need to go back to the Bretton Woods system. This system was created after World War II and was designed to stabilize global currencies by linking them to the US dollar, which was backed by gold. For a while, it worked very well. But by the late 1960s, cracks began to appear. The United States started facing increasing financial pressure, and confidence in the dollar began to weaken. The system that once provided stability was slowly moving toward collapse. Main causes, several major factors contributed to this crisis. First, the Vietnam War was extremely expensive, draining US resources. At the same time, the government was funding large social programs, which increased spending even more. This led to growing budget deficits. As the US printed more money to cover these costs, more dollars began circulating around the world. But there was a problem. These dollars were supposed to be backed by gold, and the US did not have enough gold to match the growing supply of currency. Triffin dilemma. This situation was perfectly described by economist Robert Triffin. He explained a key contradiction. The global economy needed US dollars to function, but the more dollars the US supplied, the less confidence there was that those dollars could actually be converted into gold. This became known as the Triffin dilemma. It created a system that could not sustain itself in the long run. Eventually, countries began questioning whether the United States really had enough gold reserves, and once that doubt appeared, the entire system was at risk of collapse. Market shock. When Nixon made his announcement on a Sunday evening, it was not a coincidence. Financial markets were closed, giving governments and banks a short window to react. But when markets reopened on Monday, the reaction was immediate and dramatic. Currency markets froze, banks worked overnight to manage the uncertainty, and confidence in the entire system of fixed exchange rates began to collapse. The world suddenly realized that the rules of the game had changed. Floating currencies. In an attempt to stabilize the situation, countries tried to repair the system, but these efforts did not last. By 1973, major currencies began to float freely against each other. This meant that exchange rates were no longer fixed, but instead determined by supply and demand in global markets. While this gave more flexibility to governments, it also introduced new risks and volatility. Businesses now had to think about currency fluctuations in addition to production and trade, impact on people. For ordinary people, these changes had very real consequences. Prices began to rise more quickly, and inflation became a visible part of everyday life. Savings started to lose value, and borrowing became more expensive as interest rates increased. Many people began looking for ways to protect their wealth, often turning to real assets like gold or property. What had once been a stable economic environment became uncertain and unpredictable. Oil crises. Just as the global financial system was adjusting to these changes, new shocks appeared. In 1973, an oil embargo caused energy prices to rise sharply. Then, in 1979, a second energy crisis hit. These events did not originate from the monetary system, but they made its weaknesses much more visible. Rising oil prices affected transportation, production, and food costs, spreading inflation throughout the global economy. Gold and silver. During this period of uncertainty, gold and silver became symbols of safety. The price of gold rose dramatically, from $35 per ounce to around $850 by 1980. Investors rushed to protect their wealth, and speculation increased, especially in the silver market. People believed that if paper money could lose value, then physical assets like gold would hold their worth. This mindset spread across countries and financial systems, petrodollar system. At the same time, a new system began to form. Oil started to be traded globally in US dollars, creating what is known as the petrodollar system. This meant that countries needed dollars to buy energy, strengthening the global role of the US currency. Oil-producing nations deposited their profits in American banks, which then lent that money around the world. While this supported global growth, it also contributed to rising debt, especially in developing regions. Europe response. Different countries reacted to these changes in different ways. Germany focused on maintaining a strong and stable currency through disciplined monetary policy. Switzerland also maintained stability with its strong franc. However, not all countries were as successful. The United Kingdom experienced high inflation, and other parts of Europe faced economic instability. These differences showed how important national policies were in adapting to the new global system. Volcker policy. By the late 1970s, inflation had become a major global problem. In response, Paul Volcker, the chairman of the Federal Reserve, introduced a bold and controversial strategy. He sharply increased interest rates to reduce the money supply and control inflation. This led to interest rates rising above 20%, which caused a severe recession. However, despite the short-term pain, this policy was successful in bringing inflation under control. Long-term lessons. Looking back, the events that began in 1971 completely reshaped the financial world. Gold lost its central role in the monetary system, and countries had to rely on policy discipline instead of a physical anchor. Investors learned the importance of diversification, spreading their assets across different investments to manage risk. The modern financial system, with all its complexity and flexibility, was born from this period, and its effects are still shaping our economy today.